Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. Hope everyone has having a good morning, keeping their head cool in a hot market and focusing on the trends, focusing on the flow, and focusing on, albeit a smaller group of opportunities, but nonetheless, there are opportunities out there, whether you're day trading and taking advantage of the volatility, or whether you're just waiting for those longer term wish list weekly time frame, build a portfolio while the VIX is at the moon levels. There are things we can do. They're just different than the things we did in the first half of the year, or even, frankly, 60 days ago. So always looking at where the flow is at, not sticking with a fixed group of symbols, because ultimately our best edge is our watch list. So let's get to it. Every morning I'm looking at exactly that. What today is an opportunity? Maybe it's a sector that I haven't spent a lot of time looking at in a while because there was no reason to, but there is now. Things like ITB. Maybe some folks are out there saying, Rog, I've never really heard of the carry trade and I've never really looked at the yen and so forth. How would I possibly trade that? Are there futures? Are there ETFs around these countries and these currencies? Absolutely. If you're a futures trader, you're probably already very familiar with the 6J. This is the Japanese yen versus US dollar. Basically, think of it as a Forex pair, but trading as a futures contract. Maybe you're wondering, Rog, is there a way to trade the way in which the Japanese economy is responding to this? Absolutely. You can take a look at something called the MSCI iShares. There's a number of countries that are represented, and Japan happens to be one of them. That's the EWJ. So not that we're going to jump into those necessarily, but for now, until this whole carry narrative is played out, we want to be a little bit more prudent, right? We know the NASDAQ is below the anchored VWAP for the year. We know the S&P is testing that area, right? As you can see here, which, someone said, Rog, in a game of trade this, not that, which is really the essence of watch list building. Where do I want to put my money? Where do I want to put my attention? Where ultimately my trades occur? Take a look at what's happening with the ES. It does look a little bit better than the NAS in terms of where it sits on the daily time frame. The Dow, same thing, right? See, the Dow is kind of hanging on to that VWAP. We want to keep an eye on that. What else is looking pretty darn good? Well, we've been talking about staples and utilities in this room for well over a month, because throughout July, your outperformers were really three names. And at the end of July, it was four. Regional banks, which of course have been hit hard because of the sell-off in the Russell. Staples, XLP, and utilities, XLU. And the latter two, XLP and XLU, are defensive sectors. They have energy names. Obviously, your NextEras are an XLU, Southern, Dominion, Duke. And in staples, you've got things like Coke and Procter & Gamble, Mondelez. So again, it's a very different list than looking at NVIDIA, Apple, and semiconductors, right? And that's that flexibility, that fluidity that we need as traders to say what was working then is not necessarily working now. And, we trade the now, right? Power of Now, good book for traders too. What's happening now? So another thing that I would recommend keeping an eye on is gold, but even more so GDX, and even more so going down that alignment, NEM, good looking stock. There was a fourth sector that really started to make its way to the top of to the leaderboard, if you will, of strength, and that was healthcare, led by United Health, Johnson & Johnson, Pfizer, AbbVie, and a whole host of other names within the healthcare sector, XLV, that have been relatively outperforming things like tech. Let everyone else worry about where NVIDIA and Amazon and Microsoft and Meta are going next. Wait for that dust to settle. Wait for the NASDAQ to get above that anchored VWAP. Things will have much better follow through, especially for swing trades at that point. But in the meantime, there are names that are behaving pretty darn well, right? So ultimately, so much of what we do as traders, and the Pareto principle applies. 80% of our time should be actually sharpening the saw, right? Who's not read Stephen Covey, 7 Habits? What is the watch list that we're going to focus on? Get that right, trading gets a whole lot more clear and easier. Get that wrong, and ultimately, you could be doing the right thing, for the wrong stock, meaning a stock that's less likely to follow through. And it's not that complicated. Spend 80% of your time figuring out what stock you want to trade and the direction you want to trade it. And then 20% of your time trading, right? That's trading like a sharpshooter. That's trading like you know your price, and that's where you'll engage. And that's something we could all learn. Why I don't celebrate big money. Smart money is about the dumbest thing we could say. There's no such thing, right? But there is big money. And I will say the one thing that institutions do better than retail traders, things that we can learn from, is they know their level, and they're not doing anything until price gets to that level. They know their levels. They know their risk to the book. They know their risk based on volatility, right? And those are things that we can also, and those are the best things that we can learn from quote unquote big money. Mind you, though, and this is where yesterday, if y'all read the email that went out, this is why I said the day before was a big, dumb money move. They're the ones that got caught. I don't know about you and I didn't have a carry trade on. I wasn't borrowing yen to buy NVIDIA or whatever they were doing. I wasn't buying yen to buy New Zealand dollar. And if I was, look, there is over a 5% chasm between even the heightened rate of the Bank of Japan central bank rate and, say, the New Zealand Reserve Bank, right? The RBNZ, the Reserve Bank of New Zealand. It's over 5% of chasm between the two. Even now, it was greater before. So think about how razor thin, dumb a trade it must have been, where a 0.35 move or even just a breakout in the dollar yen sent them scrambling, right? Oh, wait a minute. Dollar yen has been strengthening since the middle of July, right? But they met their thresholds, their tiny little thresholds by August 2. Makes no sense, right? So please don't think there's smart money out there. I have always bet on the retail trader. I respect that person who's usually trading alone, or, we'll talk about why having a room is so important. We'll do that maybe in an upcoming video. What do I get out of being in a room, Rog? Why would I want to do that? They're not free, right? It's going to take my time. It's going to take some money, but what's the advantage? What's the edge I get from being in a group of traders who are trading the markets together, right? But in the meantime, also think about the fact that when we have these kinds of shifts, it's not going to affect everybody. The entire carry trade does not have to be unwound, because not the entire group of traders, asset managers, portfolio managers, hedge funds, whatever, have dumb trades on. The ones that had to unwind on Monday, big dumb money. Let's get it out of the way, right? They like to call us retail traders dumb money. I disagree. We're managing our own risk. Nobody comes to bail us out, right, when we blow up. So like I said, I respect the retail trader a whole lot more than I'll ever respect smart money, right? Big money, smart money. What a riot. Okay, so there you go. That's the way I'm looking at this week. That's the way I look at trading. Manage risk, find the trends. They are out there. So let's take a look at XHB. Yeah, John. So ITB and XHB, they're pretty much the same thing, but they're organized differently. So ITB is the high concentration weighted version of your home builders and all those ancillary stocks that would kind of be put in the home building, the construction sectors. XHB is not the high concentration weighted version. So if you look at the top 10 or 15 names in those two sectors, you'll notice they're pretty darn similar. But the dissimilarity is in the way that they're weighted in the sector. So absolutely, if you want to go crack open either one of these, and I usually have do I not have that up? All right, I was going to open up my sector. Look, oh, I must have that closed. Well, anyways, so when I open up the multi-chart, let's do it this way. Bear with me one moment. So when we're looking at, for example, ITB, I'll bring that in right now. And I would say I'd probably prefer ITB because it's going to be a lot clearer as to why a sector and the stocks within ITB move, because the high concentration weighting actually is an advantage. It's a problem for investors because a lot of times they find out, sometimes too late, that they've got way too much exposure to a handful of stocks. If you're in QQQ and XLK, that's pretty much the same position, right? If you're in a bunch of Apple, Microsoft, Amazon, the Magnificent Sevens, and you're in the QQQ, that's the same position, right? That's high concentration weighting in your portfolio. But we want high concentration weighting in terms of ETFs and indices because it's easier to understand why they're going to do what they're going to do. So this is the ITB, this right here. This is the ITB. Take a look at what's in it. DHI and Lennar are your biggest names, and NVR too. So where this goes is largely going to be where DHI and Lennar take it. And then those two would be in many ways like the tide, right? If you want to think about it, what the similarity is, it's like a tide that lifts all boats. Will it lift all of them? No. But if there's buying in ITB, there's buying across the board in these names, just to different percentages, to different weightings. So as far as a long on a dip, ITB, XHB, if you're buying shares or getting long calls, yes, I like that. I also would say keep an eye on DHI and Lennar, John. Yeah, for sure. All right, what about gold? Okay, let's go take a look at GC. Now, before I trade anything related to gold, maybe you're looking at GLD, maybe you're looking at GDX, maybe you're looking at micro gold. All of this is really easy to track, and I've been teaching this in the rooms. We've got some free videos where we would do the same thing with the S&P, right? How many different ways are there to trade the S&P? Plenty. S&P Mini, that's the touchstone, the main chart I'll look at. Then there's the micro S&P, there's SPY calls and puts and calls, and there's SPX puts and calls as well as XSP. There's a number of ways to trade the idea that we would find on that 23-hour version of the S&P 500 index, and that's ES. So now take that mindset over to gold. So I look at GC, there's micro gold, there's GLD, the miners, and then there's all those stocks weighted within them. So keep in mind, once you get a feel for what GC is doing directionally, you've got some clarity, then all those things will start to also start looking better and better. Do I like gold today? Not until it hits about 24.10 and a quarter. Dugan, I would not really look at until it gets a little bit lower. Now, we've had some of those lows with a lot of volatility on Monday, a little less volatility yesterday, but that's what I would look at to get long gold. I'm not going to buy a symbol, right, like this. I'm not going to buy the gold market on its way out of the strike zone, right? So if I'm looking at, if I'm a batter at the plate and the ball's already gone by and then I swing, the timing isn't there, right? So we know timing is trading. And for me, timing is when do these green candles sink down into that gray volatility support zone? And that's when I'll get, say, long GC, long MGC, long gold miners, right? Long Newmont mining, calls, puts. Those are all choices we have on GC futures and GLD. And I would stick with the call side of this trade. I would absolutely stick with the call side of this trade, get long. So I'm with you, but just not at current levels. Again, timing is trading. Is price, what I alluded to before with institutions, they know their price. They're disciplined to that. This is the price at which the risk makes sense, the cost basis makes sense, and the upside, the risk to reward makes sense. And remember, gang, retail traders have a terrible habit. There's two of them. One, they add to positions, right? If I buy something at $3, $2.50, right? I've got risk from a $3 spend, right? I've also got risk from 50 cents. But on the way up, either I have a new cost average, which is obviously a little bit lower, but on the way back up, a lot of traders delude themselves into thinking, oh, I'll just take the profit on that 50-cent entry that I got. But that's still underwater on the other two. That's one really bad habit. So be careful with the add, because unless that cost basis, an average of the positions is up, the trade overall is still down, right? So don't get bamboozled by that. We can trick ourselves into thinking we have a good trade. The other thing that traders do is they will take far too much risk on the way to some anemic reward. If we're risking 100% of debit, you've got to make it 100% profit. So if you're buying something for $1 and risking the dollar, you've got to make $1 for that to be able to be scaled out over hundreds and hundreds of trades, right? And those are some common retail trader mistakes when they don't know their levels. And especially for smaller accounts trying to grow, definitely can't do that. You'll blow up before you're able to let your process scale out and do what it does. Can I explain the concentration I just mentioned a little bit more? So Nathan, sure. The best way to do it is just actually look at the holdings And let's pull up ITB. You can do this at any number of sites. I'm at ETFDB. So I'm going to look at the holdings. You see that? That's your list of the top 15 names in the ITB. And see how DHI is 15.6%, Lennar is 12.6, then go down to the bottom of the list, right? See how those are far less? This is high concentration weighting, where a small number of stocks have a disproportionate weighting in a group of stocks. S&P is the same way, by the way. 500 stocks, all important, not even close, right? The top 5 to 6 names are nearly 20% of the S&P. Let me show you all. And this is why market internals don't ever make sense. Because if a market internal is looking at the entire marketplace of the NYSE or the SPY, and they're thinking every stock within that index, all those stocks being held are equally important, right? So take a look at the top 5 to 6 names. And then take a look at Visa. Visa's not even 1%. Does it matter as much as Apple? No, it's 7 times less important. But if I look at a market internal, they're all weighted equally, right? So be careful about that. That's where there's an error in thinking when we look at internals and think, oh, that's a reflection of the market. It's not. Those high concentration weighted names are the S&P or the NASDAQ or, whatever sector you're looking at. And that's how that works, Nathan. That's how that works. All right. Lower, dollar cost average. Yeah, it just isn't the best way. It is absolutely not. So if you average in, it's only 2 ways to think about it. Well, 3 ways, right? One, just take the loss, right? Kill the monster while it's small. Take the small loss. They're a whole lot easier. You free up mental capital, you free up literal capital, right? But if you do dollar cost average, then you've got an average cost. That is where your P&L is going to emanate from, right? Rather than the thinking of, well, I bought something at 50 cents and it's trading at 80 cents now, it's a 30-cent winner. No, it's a $2.70 loser from the $3 entry, right? So yeah, we do not want to average. And that's what adding is. That's what rolling over the position is, right? It just sounds tactical, but in reality, it's a surefire way to blow up your account. If I talk to traders who've blown up accounts in the past, and that's one thing I can say, I learned these things very early on. That's why I'm passing it on to you. My mentors told me, Rob, know your risk per trade, know your risk to your account, do not add, do not roll. And I never have. Therefore, by understanding the arithmetic, it's not even math, it's not even that specific, but understand the math, the mindset, the methodology of growing an account, whether that be small or large, I've never blown one up because there's just math around whether or not it's a disproportionate risk to your account. Right? Most traders have blown up accounts because no one's ever taught them not to add, not to roll, right? Which at scale, I don't mean, look, you might get lucky once or twice, 5 or 6 times, but over the course of your career, where you're conceivably going to put on thousands of trades, it will not scale. And that's what hurts traders. That very, very little small chance that when you break your rules, you win, right? But in reality, we know that that won't scale. Yeah, absolutely. And Eddie says, stop talking about me. Eddie, yes, I appreciate the humor at 9:19 in the morning. But I think all of us have to have someone tell us, hey, that's not the way. Because most of the marketplace will say, hey, this is what we do. And in reality, it just doesn't scale. So it's not your fault, right, Eddie? Because you probably heard plenty of people say this is perfectly normal. Max debit and adding. You will have a disproportionately large loser when you do eventually take a loser, and it will evaporate, just absolutely eviscerate how many winners in your account. That's working the mindset and the math. All right, great stuff, gang. As always, thanks for being here for Charts and Coffee. We are here Monday through Friday, 9 to 9:20. And, again, think about it as a formula, right? Say, Rog, okay, I don't like math. I'm an English major. I did everything I could to avoid math in college. So think of it as a formula, right? There's a secret formula to Coke. There's kind of a not so secret formula to account growth. Think of it as a formula. This plus this equals the output that I want, equals the outcome that I want, right? So if you have a formulaic approach and you have the discipline to the formula, right? Like Coke, I think they're doing okay. We're actually long Coke right now. Ask yourself, how do I get that secret formula? Put that in a vault and try to grow my account with a disciplined approach. All right, gang, be good to each other. I'll talk with you soon.